Imagine having a national savings account so big that every citizen is technically a millionaire. Sounds interesting, right? But that's exactly the case with Norway's Sovereign Wealth Fund, one of the largest investment funds in the world. Let's break it down. First things first, what exactly is a sovereign wealth fund? Think of it like a massive savings account. But instead of sitting in a bank, this money is out working, investing in global markets. These funds are usually set up by governments to manage surplus revenue. And they come in two forms: commodity-based sovereign wealth funds and non-commodity-based sovereign wealth funds. Norway's fund is commodity-based, meaning it was built from revenue of a natural resource, oil revenue. Many believe incorrectly that sovereign wealth funds are just for oil-rich nations, because the majority of the most popular ones were built on oil and gas. That, however, is a myth. Countries like Singapore, China, and Japan also have massive funds built on trade surpluses, foreign exchange reserves, and national pension savings. But this story doesn't start with oil.
Decades earlier, Norway had already set the stage for responsible resource management, thanks to Prime Minister Einar Gerhardsen. Coming out of World War II, Norway was rebuilding not just its infrastructure, but its entire economic philosophy. Under Gerhardsen's leadership in the 1940s and 1950s, the government embraced a strategy of long-term economic planning. It focused on state control over key industries, public investments in infrastructure, and a strong social safety net, paving the way for what would later become Norway's oil policy. In the early 1960s, Gerhardsen's government made a crucial decision. It claimed sovereignty over the Norwegian continental shelf. This meant that any natural resources found there would belong to the Norwegian people, not private corporations. Instead of letting foreign oil companies dictate terms, Norway kept control, ensuring that oil wealth would be managed in a way that benefited the entire nation. Then, in 1969, boom.
We discovered the Ekofisk oil field in the middle of the North Sea. And when we did, it was a day to remember.
But Norway had a big decision to make. Should they spend their newfound wealth right away or think long-term? To make their decision, they looked to other nations, and in doing so, they saw a cautionary tale: the Netherlands. In the 1950s, the Dutch discovered natural gas in the Groningen field and decided to shift their investment toward resource extraction and away from other forms of technological advancement, especially in their electronic and automobile sectors. They made this call because drilling for gas offered large returns for relatively little investment. Logically, who wouldn't want that? But here's the catch. This decision would later cause their economy to overheat. Their over-reliance on gas led to high inflation, a stronger currency that ultimately hurt exports, and a decline in other industries due to decreased government investment. This phenomenon has now become known as Dutch disease, something Norway wanted to avoid.
A nation's wealth should not be squandered on short-term gains. Investing wisely and managing resources sustainably ensures prosperity for generations to come.
That's Trygve Havelmo, Norwegian economist, Nobel laureate,
and father of econometric theory. Havelmo's work on the balanced budget multiplier theorem proved the already existing theory created by another more well-known economist, John Maynard Keynes. The theorem states, under conditions of a balanced budget, where an increase in government spending is matched by an equal increase in taxes, the resulting increase in national income will be exactly equal to the increase in government spending, yielding a balanced budget multiplier of 1. But what does this mean in practice?
Let's say the government decides to build a bridge. It's a big project costing $10 billion that will provide jobs, boost businesses, and improve infrastructure. But instead of borrowing money, the government wants to keep the budget balanced. So it raises $10 billion in taxes to cover the cost. What happens to the economy? Before any taxes or spending happens, the economy is stable and has $100 billion GDP. The private sector is expected to spend approximately $90 billion this year, about $60 billion on necessities like food and rent, and $30 billion on extra like vacations or new gadgets. On top of that, households and businesses save $10 billion for the future. Now, the government collects $10 billion in taxes to fund this project. But the private sector doesn't simply cut its spending from $90 billion to $80 billion, as you might expect. Instead, spending only drops to $82 billion. Why? Because people generally prefer to dip into their savings rather than drastically cut their spending. They aim to maintain their lifestyle, even in the face of higher taxes. This small shift in behavior is what makes government spending effective at boosting overall economic activity.
The government immediately reinvests the $10 billion into the economy, paying construction companies, who then hire workers and buy materials. Those workers and businesses, in turn, spend money elsewhere, creating a ripple effect. So $10 billion is taken from the private sector through taxes, and the $10 billion is injected back in, meaning GDP would stay the same, right? Even though the budget is balanced and no new money is borrowed or printed, GDP still grows to $110 billion. But why? Having a budget multiplier of 1 means that every $1 the government spends results in a $1 increase of cash flow. This assumes peak efficiency. Contrast this to the private sector, who have a marginal propensity to consume of 0.8, meaning for every $1 they receive as income, the private sector only spends 80 cents, making the private sector less efficient as compared to the government at directing money toward immediate and productive uses. This is the essence of the balanced budget effect. A government can increase economic activity and production without increasing debt as long as it spends what it collects efficiently. Just like a government can tax individuals in a way that encourages them to draw from their collective private savings to fund projects without harming the economy. Norway applied a similar principle at a national level. Instead of spending its oil windfall immediately, Norway chose to create a collective public savings account, the Government Petroleum Fund, established in 1990. The idea was simple. Rather than letting oil revenues flood the economy and cause instability, like gas did in the Netherlands, they would invest the wealth globally and only allow a small, controlled withdrawal, typically capped at 4% per year, to fund government budgets. Under the leadership of Knut Kjær, the first head of Norges Bank Investment Management, the fund adopted a sophisticated investment strategy, ensuring that resource wealth would be invested for future generations. This disciplined approach transformed a finite oil resource into a self-sustaining financial engine.
By 1996, approximately $2.5 billion was invested in foreign exchange reserves, our first capital transfer. By 1997, the fund, then worth approximately $4.2 billion, was entirely invested in government bonds. But that changed in 1998, when we shifted 40% of the portfolio into stocks, marking the beginning of a more diversified investment strategy. By the end of that year, the fund, under the management of Norges Bank Investment Management on behalf of the Ministry of Finance, had grown to around $10 billion. By 2004, we introduced ethical guidelines to ensure responsible investing And by 2006, we rebranded from the Government Petroleum Fund to the Government Pension Fund Global to reflect our long-term commitment to future generations. Then came 2007. The Ministry of Finance decided to raise the share of equity investments from 40% to 60%. A bold move that paid off. But in 2008, the financial crisis hit hard, causing a negative 23.3% return, the worst in our history. The fund dropped to just under $200 billion US. But here's the thing. Because we played the long game, we recovered. By 2009, we posted a record 25.6% return, pushing the fund past approximately $234 billion US. In 2011, we made our first real estate investment, buying a 25% stake in London's iconic Regent Street. By 2013, we entered the US real estate market, and the fund had ballooned to about $450 billion US. Fast forward to 2017, another historic milestone. The fund hit $1 trillion US for the first time. By 2021, we took a new step, investing in renewable energy for the first time, with a stake in an offshore wind farm in the Netherlands. And today, in 2025, the fund is valued at $1.8 trillion US, or approximately 19 trillion kroner, making it the largest individual sovereign wealth fund in the world.
This fund doesn't just sit in a bank. It owns stakes in over 9,000 companies worldwide. From Apple to Nestle to Tesla, Norway has a say in some of the biggest boardrooms on the planet. Imagine if more countries did the same. What do you think? Should more nations follow Norway's lead? Drop your thoughts in the comments below. If you found this interesting, hit that like button and subscribe for more deep dives into history. See you in the next one.